Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next. Welcome back to Macro Insight. Today is the 10th of November, and let's talk about the markets. Obviously, since last week's call, we had a couple of big things. We had the US election, obviously, which I had been calling the best vol selling opportunity of the year, which it kind of was. With the VIX getting hit from, around the 40 level down to the low 20s. That was kind of what I was calling for. And it happened. Why did it happen? Because we got the kind of removal of that uncertainty of the election with a bit of a Biden landslide, despite obviously Trump contesting it and calling it voter fraud. Of the mail-in ballots, the market is still pricing or taking it as a Biden win. Even though if you look at the betting markets, they've come in a bit to reflect still roughly 10% probability that Trump could still retain the presidency, which is interesting. Now, there are some technicalities about how the electoral college process works and the fact that the real election doesn't actually happen until mid-December, when the electors from all of the states actually submit who they're electing as the president, and they're supposed to do what they've been told to by the people. But sometimes you can get some craziness where electors basically don't do what they're meant to. And apparently that happened in last time's election in 2016. And these are called faithless electors. And apparently if you get enough of them, you could get all kinds of shenanigans, and maybe Trump's not out of the game yet. So something to be aware of. I'm not saying that's what's going to happen, but something to be aware of, because most average people would have no clue about that. So something to keep on the radar and not completely priced to zero, I would say. So the trades that I've been recommending, if I share the screen, to sell vol. Obviously there's more aggressive ways and there were more safe ways, as I called it. So the VIX, we can see the VIX spot here went from around 40 down to 25. If you had sold the December futures outright as the more aggressive play, they went from around 34 at the highs, but let's say you got your short on at around 32. You could trade out of those at 24 yesterday or even 25 today, let's say. So that's a good 7 odd vol points that you could have captured in a matter of a week. So not bad. Now that was the more dangerous play, just selling outright futures. The more defensive play that I mentioned was the calendar, which was obviously selling December to buy January. Remember on this term structure that we talked about. You were able to sell that with December 2 vol points above the January, and now you're looking at December at about 0.3 below. So that would have made you about 2.3 vol points in a much more defensive, safer kind of way, right? So that was the other trade. Outright puts on VIX have done all right as well. So the December puts on VIX, I own some 25 strikes. They went from about 1.5 points to worth about 3.2 right now. So they've slightly better than doubled in value. Again, you were never going to lose more than your premium on that trade, and you've now doubled your premium. So not too bad, 100% return on capital. And then the last thing was the condors, which was more of a realized vol play rather than a pure implied play. And that has kind of done its job in that we've just experienced, and we'll talk a bit more about what happened yesterday, but we've experienced some pretty crazy realized volatility over the last week. And yet those condors have allowed you to stay short vol, not get blown up, not be stopped out, and they are roughly the same sort of price, if not slightly profitable from where we put them on last week. Right? And the specific condors I'm talking about there are the December ones, with strikes around the 2,900, 3,000 on the downside and 3,600, 3,650 on the upside. So, you know, you could easily still sit with those for another month and collect your decay without too much trouble. But then the good thing about them is they're not going to blow you up, right? Sorry, the biggest development has been yesterday's news that Pfizer has developed a COVID vaccine with 90% efficacy in its trials. Now, this is kind of Pfizer's independent report that they've written. It's not peer reviewed yet, the study, and we'll see over the coming sort of 2 weeks, I think, more data on it, more validation of it and the results. So, but it looks very positive, better than the market was maybe expecting on the first attempts. There will still be obviously distribution issues in terms of the vaccine and getting it out to the people. That will take, you know, a year to get it to a lot of people, right? Or enough people, let's say. But also you've got the concern, you know, will people feel safe taking the vaccine? Apparently there was a UK survey done that showed about 40% of people wouldn't want to take it anyway. And the truth is, if you're a young person and you're not in the high risk range on COVID, say, you know, 70, 80 years plus, then yeah, maybe you will feel more comfortable just taking your chances of getting COVID rather than sticking a vaccine in you that has been arguably rushed through and you're not entirely sure what the side effects may be, if any, right? And also in general, people's kind of attitude towards vaccines and stuff, not everyone's so pro-vaccine these days, right? So you may struggle to actually get everyone to take it. Anyway, that remains to be seen. But the point is, the market is liking it because if there's a vaccine available and it can get disseminated to the higher risk people, then all these restrictions to our lives and our businesses get lifted and the economy can rebound strongly, right? So this news could be a massive game changer. And that's what the market has basically started to price, okay? So I call it the flight to unsafety, right? So what we saw yesterday is, you know, it triggered a massive kind of rotation out of the tech work from home kind of stocks, like the mega cap tech stocks in the US, obviously also out of some of the safe havens like gold, precious metals, etc., and then into the beaten up travel and leisure, oil stocks, small cap stocks, financials, all those things, right? So we can have a quick look at some of those charts. So the Russell, which is the small cap index, enormous move from 1650 up to as high as 1750 in one shot. That was up about 6-7%. You've had, you know, some of the banks, I mean, are spectacular, some of the moves in the banks. So if we look at the sectors, XLF, I mean, yeah, XLF was up about 12%, okay, which is insane for XLF to do that in a day. So banks obviously loving it. You know, these are all the names that were basically more reflective of the real economy and the fact that, you know, we had this massive cloud, you know, over our heads on COVID that was going to impact consumption, was going to impact, there was a lot of unemployment, you know, all those parts of the economy that were struggling. Those stocks that were affected and disrupted, those industries, have just had a massive relief rally, right? So you had oil up 10% as well. But some of the real beaten up travel and leisure names like Carnival Cruises, some of the airlines, hotel stocks, entertainment stocks like Six Flags in the US, these are the garbage stocks that I've talked about over the last couple of weeks, saying that at some point there's a massive re-rating in those names if we get a vaccine by the end of the year. I didn't know this news was coming in early November. I thought this news was coming, but I thought it was coming maybe in December sometime. So it's come a bit earlier than I would have liked. So I wasn't massively geared up for it. I had some of these stocks in my longer term pension books, so I did okay. So, you know, some of these stocks are up 35% yesterday, which is ridiculous. But, you know, so I feel okay that I got some on board, but this news was a little bit faster than I would have liked, right? But it's here. So you've got to trade what's in front of you. So what do we think going forward? I expect this rotation's got some legs still to continue over coming weeks and likely maybe even into year end, unless we get some contradicting data come out on the vaccines and that optimism like gets dialed back down again, right? But otherwise, I would expect, you know, we've seen this massive amount of money put into the tech stocks, the only place to hide. And I think money will come out of those and it will go into some of these value sectors, whether it's the banks, whether it's the oils, whether it's the travel and leisure. I think that movement is going to continue basically, right? So I wouldn't get in the way of it right now. So the big story obviously is gold. Gold was down about 4.5% yesterday. And like I say, it's this flight to unsafety, right? So part of the allure of gold is that we're going to be in a, you know, low rate environment. All this money printing and stimulus is happening. Real yields are going to stay negative and go even more negative. Dollar debasement, all those things were gold bullish. And also you had the argument that part of your rates, part of your bonds allocation should be in gold now with yields where they are. So all those things are why people were camping out in gold. Obviously, now some more optimism coming through that we might get growth, we might get recovery. Do people need to be in gold as much? Maybe not, right? So obviously a massive candle here, taking gold from around 1965 to lows of about 1850 in one shot. You know, very, very, very interesting to keep an eye on gold here. I favor gold to probably go lower first. I think 1830 is a pretty strong support level. Below that, I've got around 1765, 1770 as a next major support level. If we don't hold 1765, then it could signal all kinds of trouble for gold, basically, right? So I think it's one to watch. I think here, if you've got a gold allocation, you should be cautious. You should think about hedging it. That's certainly what I've done. Because we're at this point where, you know, we might be, whereas it looked like we were in a stagflation setup for the next quarter, right? The next few months, we might be moving from stagflation to more like inflation and maybe even some growth, right? And in that move, in that transition, gold is not necessarily going to be your best friend, right? So moving away from some gold exposure and maybe into things like real estate or industrial commodities, which have inflation component, might make more sense, because there is a risk here that if we start to think that we're getting a recovery, you're going to see bonds sell off, you're going to see yields rally, and until we actually see inflation come through, you might see real yields go up quite a bit. And if real yields rally, that's normally pretty bad for gold, basically, right? So there's a risk in gold. I've hedged some of my exposure via options. Full disclosure, I've done I had some 1750 puts in January, end of January expiry. I've bought more of those, and I've sold some 2050 calls to finance them. So I've got that on as my structural hedge for gold. I will probably increase it if we get any kind of bounce in gold. If you look at the price action here, obviously, if you're a wave count type person, then you may well think that move down is going to be met with a sort of bounce, maybe up towards 1900, and then we go down again. So in a move up towards 1900, I would be adding to my hedges in gold, basically, right? So yeah, Bitcoin's an interesting one. Like the price action in Bitcoin, for me, was very strong yesterday. Given what gold and silver did, I mean, I had some November 16,000 calls on my book. And I dumped them when I saw gold and silver do what they do, and I was like, okay, Bitcoin's only down 1.5% when they're down like 4% plus. And I put it on Twitter as well. I was just like, yeah, I'm gonna dump I'm not as confident now that Bitcoin's just going to shrug off what they're doing, because a large part of the Bitcoin move has been, well, certainly the narrative has been, monetary debasement, weaker dollar, blah blah blah, same kind of drivers as gold. So I thought it was going to be hard for Bitcoin to completely ignore what gold is doing. So that's that. For me, it was like, did I have strong conviction that these 16,000 calls in end of November are going to blast through their strike? My conviction was dropping. So I sold those out, and I'm hoping for a pullback. So just like if gold does have a pullback towards 1830 or even lower, I wouldn't be surprised to see Bitcoin kind of pull back to it, maybe back to this average here around 14,000. If it gets lower, great. Even sort of 12 and a half, that would be amazing as an entry point. but I'd be looking to probably, I've still got some longer term positions, but I just don't have any short dated calls anymore. But if we got down to 14 or maybe lower, then I'd be looking for opportunities to get back into the short term plays as well, right? Which I'm not in at the minute. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.